Hello everyone, and welcome to Getting Back to Work in Sydney. It's a beautiful day and the markets are certainly very excited by what's going on. We're seeing one of those rallies today that everyone, it's very easy to believe in, and even myself as a bear, I was starting to think maybe this is a turnaround rally. But I would just suggest to you that every now and again we do see very strong rallies. They last for 24 to 48 hours, and then unfortunately they pile back in on themselves. Whether this is one of those or not, it's really difficult to say. The Australian market's looking a lot stronger than the US market on the day, and that would be because, one, New South Wales is opening up, though cases in Victoria are getting to worrisome levels where perhaps it will not be as easy for Victoria to open up as was first hoped. Nevertheless, the opening up, everyone's enthusiastic. It's so nice to be out and about again, and people are able, obviously, limited dining and hospitality and retail back is a very strong thing. And I think pretty much the entire office world decided they would go back to work as well, even though it wasn't really, I think, mandated as yet. So things are definitely picked up. So the rally in Australia, very much a lighter heart, if you like, an enthusiasm by fund managers and investors and traders in Sydney. But also there is that thing about the Reserve Bank of Australia. So whilst high inflation numbers in America are becoming openly debated as a good reason for the Fed to think about hiking rates sooner rather than later, but of course by sooner I mean 2022, the first half. For 2022, that remains my forecast. It's been my forecast for some time that we have tapering this year, and even in the first quarter of next year have a Federal Reserve interest rate hike. Of course, that's an entirely different story to what we're seeing in Australia, where the Reserve Bank of Australia has bizarrely, unlike any other central bank I think in the history of the world, declared that its policy is to sit on its hands until 2024. I think they're still expecting to get paid during this period where they've already declared they're not going to do anything. And if they're going to earn their pay, which by the way they reviewed for themselves and greatly increased only a couple of years ago, I think they do need to consider that they will have to eat their hat, so to speak. Eat their words, certainly, because the RBA at some point is most definitely going to have to say, where now things have changed. They won't say we got it wrong, they'll say things have changed, so now we have to consider that interest rate hikes may happen sooner than we had previously thought. Of course, after they've reassured the Australian public again and again and again that nothing will happen in 2024, and a whole lot of people have gone out and bought mortgages based on that, and some stock portfolios, that could come as a little bit of a shock when it eventually does occur. It's not immediately around the corner. They should never have put themselves in this position. It's very bizarre. It's extreme central bank policy by global world best practice standards. It's way out there, but they've done it to themselves. So now how do they get themselves out of that? Because inflation is here to stay. And I keep saying the reason most people don't understand why inflation will be persistent, and remember I said all this several months ago when I did say the Fed has it wrong, the Federal Reserve is wrong, the Reserve Bank is wrong, they will eventually figure it out and they will be hiking rates sooner than they themselves think. And that's certainly already the Federal Reserve starting to go down that track, and I think that will happen in Australia. But the reason I was able to make all these forecasts is that I simply understood the human aspect of what was going on. And that was decision makers of small, medium, large businesses, even the largest corporations in the world, were realizing that they had increased cost due to the disruption of the pandemic. Supply chain disruption is the key phrase, of course. They had increased costs, but maybe they should increase their prices a little bit more. And then it took them a few months to realize, oh, and when we increase prices, we don't lose market share. So why don't we increase prices a little bit more? And that's why earnings have been strong, because profit margins have been fattened, and that's why we have inflation. On top of the legitimate supply chain disruption, we have freedom of pricing. And when you combine the two, you have long-term inflationary pressures, because for the first time in 2 decades, people can raise prices without losing market share. They couldn't before. We had global competitive price pressures. They're kind of subdued at the moment. Those competitive price pressures, they're almost non-existent. So that's why we're getting strong earnings, high inflation, and that's going to continue. And we're going to see that in Australia as well. Everyone in Australia is excited about the opening up, and well, they should be. It's a good thing. But in the medium to long term, it's not going to mean a booming economy the way we had last time. I don't think we're going to see those same levels of GDP rates quarter on quarter that we saw in the last opening up. I do think we're going to see higher inflation. And if we do open New South Wales up to international travel, expect Australia's unemployment rate to edge up, because there's a lot of people who normally maybe wouldn't have had jobs in hospitality and retail that now have them because there haven't been the foreign travellers to fill those spots. That's a bit of an early call on that one, but it's something to keep in mind. So stagflation, where you have high inflation, rising unemployment, could still eventuate. That's a word I've used once or twice. We don't have it yet, but we most certainly could. But what we do have, and what my primary forecast is, that we're going to have sluggish economic growth in Australia with strengthening is the wrong word, rising inflation. And I think the Reserve Bank needs to unwind some of the massive stimulus. Let's face it, the government's been doing big stimulus spending, selling bonds. The RBA's been buying bonds, and it's had interest rates at 0.1%. And we're going to have below trend growth, but we're not going to have disastrous economic growth. And that means that we're going to have a far weaker economy than everyone else is forecasting, because again, ACY says it first, and we're the ones who get it right. Touch wood. We don't always get it right. Well, certainly I don't. But I do try to call it as I see it. And as I see it is far more subdued economic growth going forward than the market expects, higher inflation than the market expects, and an equity market that's already, I think, too celebratory. And so I think there is downside risk for stocks or heavy stock price action over the medium to long term. On the day, the market looks good. On the day, the Australian dollar looks good. Again, I think the US dollar is going to remain firm over the long term. What about my call on gold? I did tell you all, keep accumulating gold. Huge jump in gold last night. Good to see. And I think that's going to be a trend. I think that's just like a first little taste, tiny little taste of how gold could react to ongoing high inflationary pressures in the United States and elsewhere in the world. Thank you very much. Clifford Bennett, Chief Economist, ACY Securities. Hope to see you on the next podcast. Thank you.